The best energy stocks to buy now. Welcome to today's audio presentation, where we'll be discussing some of the best energy stocks to buy right now. Energy stocks have always been a crucial part of many investment portfolios, and for good reason. They provide multiple benefits to investors, including portfolio diversification, strong dividend yields, and the potential to capitalize on rising oil prices. If you're considering adding energy stocks to your portfolio, this presentation will walk you through some of the top picks in the sector and why they may represent great buying opportunities today. Why energy stocks matter. Before we dive into the specific stocks, let's first talk about why energy stocks can be so appealing to investors. Unlike many other sectors, energy stocks tend to perform independently from broader market trends. This is because the energy sector, particularly oil and gas, is driven largely by supply and demand dynamics, geopolitical events, and shifts in global economic conditions. As a result, even when other parts of the market are struggling, energy stocks can often provide a safe haven for investors looking to hedge their portfolios. Energy stocks also offer another significant advantage: high dividend yields. Many of the largest energy companies in the world pay substantial dividends to their shareholders, which can make these stocks particularly attractive for income-focused investors. In periods of market volatility, having stocks that pay consistent dividends can help smooth out your portfolio's performance and provide a reliable source of income. Another critical reason why investors are drawn to energy stocks is the potential to benefit from rising oil prices. As oil prices climb, energy companies tend to generate higher revenues and profits. This correlation can make energy stocks a valuable tool for investors looking to profit from higher commodity prices. Historically, energy stocks have performed exceptionally well during inflationary periods when oil and gas prices rise in response to increased demand or geopolitical disruptions. With these factors in mind, let's take a closer look at the energy sector's recent performance. Over the past year, the U.S. Energy Index has returned approximately 3.26%, while the broader U.S. market has seen significantly higher gains of around 34.2%. At first glance, this may seem like a large gap, but it actually signals a potential opportunity. Many energy stocks are currently trading below their intrinsic value, which means there may be significant upside for investors who are willing to take a long-term view. Right now, several energy companies appear undervalued, which could offer a great entry point for investors. I've identified 5 energy stocks that stand out as some of the best buys in the sector. Each of these companies has strong economic moats, meaning they are well-positioned to fend off competition and generate long-term value for shareholders. Additionally, these companies are currently trading below their fair value estimates, making them attractive from a valuation standpoint. Top 5 energy stocks to buy now. Let's start with the first company on the list, SLB, formerly known as Schlumberger. SLB is the world's largest oilfield services provider, offering a comprehensive range of services to oil and gas producers around the globe. The company's extensive portfolio includes everything from drilling technology to production testing and project management services. One of the key reasons SLB is a top pick is its global presence and ability to operate in various markets outside of the U.S. This international exposure helps mitigate risks associated with regional downturns in the oil and gas industry. Currently, SLB is trading at a 31% discount to its fair value estimate of $62 per share, making it an attractive option for value investors. The company also offers a forward dividend yield of approximately 2.56%, providing investors with a reliable source of income. What sets SLB apart from its competitors is its commitment to innovation and technology. The company invests heavily in research and development, with roughly 20% of its annual revenue coming from new technology. This focus on innovation has helped SLB maintain a dominant market share in key segments such as wireline services and logging while drilling. Looking ahead, SLB's Asset Performance Solutions business is expected to be a key growth driver. This division allows oil and gas producers to outsource their entire project management operations to SLB, resulting in significant cost savings and improved efficiency. Additionally, SLB's Delphi ecosystem provides a scalable software platform that enhances project management and boosts profitability. By integrating advanced digital solutions into its offerings, SLB is well positioned to capture future growth opportunities in the oilfield services industry. Moving on to the next company on the list, we have HF Sinclair, which is currently trading at approximately 30% below its fair value estimate of $64 per share. HF Sinclair is an integrated energy company that operates in refining, marketing, and renewable fuels. One of the key factors that make HF Sinclair an attractive investment is its low net debt relative to its peers, which provides the company with financial flexibility to navigate periods of market volatility. The company also offers a forward dividend yield of 4.46%, making it a great option for income-focused investors. One of HF Sinclair's most compelling features is its commitment to renewable energy. The company has made significant investments in renewable diesel production, positioning itself to benefit from the growing demand for cleaner energy sources. Following its acquisition of Sinclair Oil, HF Sinclair has expanded its footprint with the ability to produce 380 million gallons of renewable diesel annually. This renewable energy focus sets the company apart from traditional oil and gas refiners and provides a clear path to future growth in a world increasingly focused on reducing carbon emissions. In addition to its renewable energy investments, HF Sinclair has a strong presence in traditional refining. The company's acquisition of the Puget Sound refinery has extended its operations to the West Coast, adding more diversity to its refining portfolio. With 7 refineries across the U.S., HF Sinclair is well positioned to take advantage of fluctuations in regional refining margins. Additionally, the company's marketing group of over 1,500 wholesale brand sites and 2 billion gallons of branded fuel sales annually adds a stable earnings stream to its revenue mix. Now let's discuss Hess Corporation, the third company on our list. Hess is currently trading around 25% below its fair value estimate of $180 per share, and it offers a forward dividend yield of 1.48%. While Hess is the only exploration and production company on our list, it stands out for its high-quality assets and strong capital allocation. Over the past few years, Hess has streamlined its operations by divesting less competitive assets and focusing on its most lucrative oil and gas properties. This includes its 30% working interest in the Exxon-operated Stabroek Block in offshore Guyana, which is expected to drive significant production growth in the coming years. The Stabroek Block is one of the most exciting assets in the energy sector, with estimated recoverable resources of over 11 billion barrels of oil equivalent. Hess expects production from this asset to reach over 1.2 million barrels per day by 2027, with 6 phases of development already in motion. This long-term growth potential makes Hess a compelling choice for investors looking to capitalize on the next wave of oil production. Additionally, Hess has a strong presence in the Bakken Shale, further boosting its production capacity and generating steady cash flow. The fourth company on our list is Halliburton, one of the largest oilfield services firms in the world. Halliburton is currently trading at a 23% discount to its fair value estimate of $39 per share and offers a forward dividend yield of 2.27%. Halliburton is known for its pressure pumping services, which are critical to the completion of shale wells in North America. However, the company's innovation extends beyond traditional oilfield services. In recent years, Halliburton has developed advanced digital solutions that allow oil and gas producers to optimize their operations, reduce costs, and improve efficiency. One of the key challenges facing Halliburton is the increasingly competitive nature of the North American shale market. However, the company's focus on international markets and its commitment to digital transformation should help offset these challenges. In particular, Halliburton's investments in next-generation equipment, such as dual-fuel and electric fleets, are expected to command premium pricing and longer-term contracts in the coming years. As oil and gas companies continue to evolve, Halliburton is positioning itself to be a leader in this transformation. Finally, we have Chevron, which is currently trading around 16% below its fair value estimate of $176 per share. Chevron is a global leader in the integrated oil and gas industry, with operations spanning exploration, production, refining, and marketing. The company offers a strong forward dividend yield of 4.42%, making it a top pick for income-focused investors. Chevron's growth strategy is centered around the Permian Basin, one of the most productive oil fields in the world. By 2027, Chevron expects to increase production in the Permian to over 1.25 million barrels of oil equivalent per day, generating significant returns for shareholders. In addition to its traditional oil and gas operations, Chevron is investing heavily in low-carbon businesses to prepare for the future. The company has committed $10 billion to renewable energy projects, with a focus on carbon capture and storage, hydrogen production, and renewable fuels. As the global energy transition continues, Chevron's balanced strategy of growth and sustainability positions it well to remain competitive in a changing energy landscape. In summary, SLB, HF Sinclair, Hess, Halliburton, and Chevron are 5 of the best energy stocks to buy right now. Each of these companies offers unique strengths, including strong dividend yields, growth potential, and the ability to navigate changing market dynamics. Whether you're looking for income, exposure to rising oil prices, or long-term capital appreciation, these stocks are well positioned to deliver value to investors.